Welcome to Tangential Soup, a weekly podcast discussing life in Australia, technology, food, fitness, and the like, hosted by myself, David Caddy, Melburnian, independent developer and tea enthusiast, as well as my good childhood friend, Alexander Carr, Sydney Sider, slave to the man, karate practitioner, and lover of adventure. This week we talk about share market trading, both in the real world and in game form. So Alex, a new season of the ASX share market trading game has started, and I'm finally in one.
Yes, you are. Now this is something I've probably talked to you quite a bit about, or at least a little bit about, and to our listeners a little bit about as well.
Yes, certainly got me interested in the whole idea.
Yeah, so basically it's to do exactly that, get you interested in the idea of trading on the share market. Now, obviously, it's not entirely realistic because when you're trading real shares, you've got to take a lot of things into account, like the brokerage costs, which the ASX share market game puts at $20 a trade, but that's not very realistic to what you'd be getting today. I think if you trade on CommSec for lower amounts of money, it is
$10.
I think $10 a trade, under $1,000, over $1,000, between $1,000 and $5,000, I think it's $25 or $30 a trade. And then over $5,000, it's actually a percentage of the total amount of money you spend.
Okay.
So, you know, obviously for large trades, it's not realistic at all, but it gives you a kind of very small idea of what it's like to trade on the share market. You don't have to pay capital gains tax or anything like that on any earnings you make. You don't have to worry about the real world consequences. So you can kind of have a bit of a play without having to worry about what it's actually like to invest with your money. But having said that, just because you come out ahead on the share market game, which I have, doesn't mean you're ready to trade real shares.
Have you ever lost money?
Yes, I have. I think the first time I played it, I lost money.
Okay.
Played about a half season, I think, or a quarter season or something. And I went down about... No, actually, sorry, it was the second time I played. And yeah, I lost money on that one. I ended up at about 44,000.
Oh, that's not too bad. You only lost 6.
It's quite a substantial amount to lose in a 3-month period.
I suppose.
It's what?
Could have been worse, though.
Over 10% of my total value?
Yeah, true.
I've got to say, I got to a point, though, and I was making some pretty stupid purchases just for the
Lols.
sake of it. Yeah.
I do like how the trades work in this, though, where you request to buy or sell something. It creates a pending transaction, and it will only actually go through when those particular stocks are available on the actual market, which is cool.
That is really cool, yeah. Which is exactly as it would be in real life. I think when you use most share trading platforms, they work in the same way. They'll just basically fill your order based on the charts on the ASX. I think with some brokers, you're actually trading on an artificial market, though. So what they'll do is they'll offer you the shares at the price on the market, but they obviously haven't gone out and immediately purchased the shares. They'll just kind of fill that order for you at the time, and then they'll keep either a cash reserve or, I suppose, the shares themselves in the background. And I know that some companies actually create entirely artificial markets and do this. So basically what they do is you can trade things called contracts for difference, which is where you can... it's a very complicated idea, and I hope I'm explaining it correctly. But basically, you can buy a contract for like a certain amount of shares. You buy a percentage of those shares with the intention of buying the rest of the shares at the time that you want to actually sell them. So basically what you're doing is you're saying, right, I want 10% of $100,000 worth of shares. So I'm paying $10,000. And then say those 100,000 shares end up, they end up increasing in value to 110,000. You then sell them. So this all is done in the background by the broker. You sell them. You never have to actually buy the whole $100,000 worth of shares, but you've then made $10,000 profit on a $10,000 investment. Now, obviously, the brokers charge you fees for doing this. I don't know what it is. Maybe it's a percentage of what you buy, or maybe it's a fixed dollar amount. Probably depends on the amount you're buying and who you're trading with. But it's a way to kind of maximize your exposure and minimize your total amount of money that you've spent.
I didn't know that sort of thing was possible.
It is. There are so many ridiculous things that are possible on the market. There are a lot of ways that a lot of kind of systems and people just work on trading or making money on small margins. And in my admittedly very limited research, it seems that there's an incredible amount of money and effort and everything that goes into the share market. And the share market itself doesn't really create any value for anybody, but it's such an important part of our lives. And obviously the economy, because the whole economy is based on it. Every single company that you see out there that's listed on the share market, which is basically every single large company in the world today, they work to create value for their shareholders. So they work for this share market. So it's all kind of very complicated. Now, I mean, it doesn't matter if a lot of the major companies own a lot of the other major companies. It's still basically the whole world. So you see that when the share market goes down, it affects everybody's lives because everybody's lives are linked to it through these large companies that participate in the share market.
Yeah, no, totally. Well, I'm glad you're going to be an expert, and I guess you're dragging me into it slowly.
I am.
I don't think I'll have a chance of beating you at this, but we'll see. I'm only down like 360 odd thousand. 100. 300.
That would be quite a large amount to be down. I've got to say though, I think that like when it comes to like what's required to actually be good at, it depends what you're doing in the market, but just buying and kind of picking the right shares. I think that you might actually have more of a knack for it than I would, because a lot of what I understand comes from being successful in the share market as a person, so not having a large amount of capital to kind of put into it. It's just more about researching and picking the right companies and then actually sticking with those companies. And I'm not really sure that those are necessarily traits that I have. Although I'd like to have them.
You have a bit of a wandering eye.
Well, when it comes to companies, maybe I do. I think... yeah, I think I'd be the type of person who got distracted by the newest, shiniest thing and then kind of bought it up and then ended up regretting it because it didn't perform well and selling it, which is absolutely not what you should do. Both of those things, really.
You should just stick fat.
You shouldn't buy things just on a whim, and you shouldn't sell them because they've gone down. But, yeah.
I'm surprised you haven't gone back to the mining shares that did you so well last season.
Yeah, well, I think they say a little knowledge is a dangerous thing, right? And I think I've got a little bit of knowledge, so I'm thinking, well, I know that the mining stocks are doing very well at the moment, but maybe I'll try and branch out and pick some winners out of other places, which is what I tried to do. But I actually ended up buying two companies that I know basically nothing about, which, doesn't really follow along with that logic, does it?
No. It's kind of a shame we're only limited to the ASX 200, though. Would prefer to pick some more obscure ones.
Yeah, that would be the fun stuff because those ones really go up. But the I think IG actually have a similar trading platform, and I have the feeling that they just use their existing list of stocks. So, and obviously IG are one of the biggest trading platforms in Australia. So potentially speaking, there might be other options.
Okay.
Look into something like that. Although I don't know. I don't know that for sure.
And now you're such an old pro at this one. What's been your best result overall?
It was definitely Oricobra. And I ended up on about 62,000 at the end of the season.
Well, that's pretty good. I mean, that beats a bigger margin than your worst loss, right?
It is actually, yeah. It's funny, but the way that I got there was actually because this game really favors short trading. So there's no real disadvantage to you if you buy a stock low, sell it high, and then you can buy it when it's low again and sell it when it's high again, because you don't have to worry about it, as I said, any of the tax implications, and the brokerage costs are so low on this game as well that if you're doing it with a large percentage of your funds, like I think you can trade 1/4 of your funds in one particular stock, and you know that a stock tends to go up and down, it's actually quite easy to do it. And that was kind of how I made my money in that other in the game that I did really well at. But it's not a tactic that you could take over to real life because of obviously all those factors that I've discussed, unless you were very good at picking it.
Wouldn't tax only come into play at the end there? So that's not a huge deal. But the brokerage cost would be for large transactions.
So the brokerage cost would be. The tax, maybe not necessarily, but you've got to look at the fact that if you're making money on this, like if I made $12,000, at the end of kind of whatever I'd been doing, all my money would presumably be in the investments, in, whatever investments I ended up in at the end of the year. But then I would have to pay tax from somewhere.
Absolutely, yeah, of course.
So I suppose that's... Maybe you're right. I mean, it's not the biggest consideration in the world, but I don't know what CGT is on share trading, but I have the feeling that it's not tiny.
Okay.
And I think it's higher if you don't hold the asset for less than 12 months.
Okay.
Don't quote me on that.
Is short trading just sort of selling with the explicit intent to buy again after it's sort of dropped in price?
No.
Or is there some other weird arrangement? Because I looked it up briefly. And it seems like it's actually more than that.
So...
But I didn't quite understand it fully.
So you're talking about shorting a stock. So
yeah.
Basically, yeah. So the idea behind shorting is you actually need to have a broker that will allow you to do it. So what you do is, so if I were to short Tesla, I would ask my broker, can I please borrow from you, whatever it is, 10 shares of Tesla, right? He would give me 10 shares of Tesla. I would give him $3,200 or whatever that would be, right?
Okay, yeah.
And then I would sell those shares on the share market at whatever price I could get immediately. So presumably about the same amount that I paid him for them, right?
Yeah, makes sense.
Now I have an agreement with him that I'm going to give him those shares back and he's going to give me my money back.
Okay, I see.
And then I wait for the share price to drop. I buy those shares back. I give him the shares back. He gives me my money back.
Huh, okay.
So he's given me the shares. I've given him the money. Wait. Let me figure this out. That's the way it works. I just got to make sure that I'm making sense here.
I guess the broker gets some small...
So he would charge probably like a monthly rate or a percentage of the amount. So, and it's usually ongoing. So the cost of lending these things is ongoing. But I think I'm making sense, right?
Yeah. They lend out the shares. You sell them immediately.
Yeah.
Then you wait for the price to go down. Then you can buy them back to give them back. And then whatever that differential is, you've made.
It's profit. Exactly, yeah.
Although I don't know what you do. It just keeps going up.
Well, that's the thing about shorting a stock. So if you buy a share, it can only go down to zero, right? But say I loaned like $1,000 worth of shares from my broker on, I think usually these things have, the contracts have time. So they might say, okay, maximum period of 5 years you can borrow these off me for, right? So I borrow them, I borrow 1,000 shares for $1 each. I sell them on the market, $1,000. They go up to $5 a share. The 5 years is up. I have to give them back to him. So I then have to buy those shares back at $5,000 and sell them to him, or effectively give them back for $1,000 per share.
Yep. Plus you've been paying him in the meantime.
Plus, exactly. Yeah. So he has obviously made a lot of money out of that. So that's kind of the advantageous side to that for the lender. And obviously, the disadvantageous side is the idea that the shares might drop. Now, the reason you bring this up, David, is because I was talking to you about my genius and original idea of shorting Tesla stocks, which we talk about a lot here.
And possibly still a genius, but not necessarily so original.
Exactly. Well, yeah, precisely. Just because a lot of people are doing it doesn't make it Doesn't make it any less genius. So basically, I had this idea. I did have it originally. Like, I knew that some people were talking about shorting Tesla, but I didn't realize it was such a common idea. And I didn't really understand how to make money from a falling stock at this stage. So I actually looked it up, and on quite a common site, I think, Investopedia, the example of how to short a stock is Tesla. I later found out that the most commonly shorted stock in America is Tesla. So it's not an original idea. I still don't think it's a silly idea because their share price, although they may be a good company, their share price is just frankly way too high for what they've achieved so far. As we kind of discussed, they haven't actually made a profit yet in a financial year.
No. Hoping too soon.
Yeah, they are hoping too soon. But if Elon Musk is anything, he's great at causing hype around things. So
he's good at spinning things.
He's good at spinning things.
They don't always come to fruition.
Yeah.
Or at least as quickly as he claims.
Yeah, and I mean, having said that, like I think that as we discussed the other day, SpaceX is doing very well. And Tesla, they're on the right track, but they're actually just not a very good quality company at the moment. Or they're not good enough to justify their share price. And I don't think that is very widely disagreed upon. I think it would be difficult to actually find someone who would enter into a shorting arrangement with you for Tesla, unless it was perhaps for a shorter period of time, or they charged higher fees on it. So it may actually not be such a profitable venture after all. I don't know. But yeah, that was kind of my brilliant idea there.
I looked up shorting in Australia because in the back of my mind, I thought there was some restriction about it. But then I found out that no, that's not really the case, but it is just sort of in popular culture for whatever reason.
Yes, it's funny you mention that because I heard exactly the same thing, that it wasn't legal to short in Australia.
Yes. And it seems like that might be the case for very specific shares, but generally speaking, no, it's fine. But a lot of brokers probably won't talk to you if you're talking about doing it on a very small scale. So that's possibly why that sort of come into common knowledge.
Well, exactly, yeah. And I think I think that the major people that will are mostly based in America. Or they'll only deal with large amounts of money, as you said.
Yeah.
Having said that, it is still possible to get exposure to it. I was just looking at ways that you could do it, and there are a lot of hedge funds tend to look at that kind of thing because they obviously have decently large amounts of capital, several $1 million, but they're not so big that if they were to acquire a short position on a company, it would actually affect the company's share price dramatically. So that's basically, I think, the way to do it. I don't really know how to buy into a hedge fund, though, so I guess that's just by the by in the end.
Have you got out of your Ripple yet?
No, I haven't got out of my Ripple yet.
It still hasn't come back to beating your price that you bought it for?
Look, can I be honest with you? It probably may never get back to that price. And I've just come to accept that. I've actually stopped. I used to be checking it quite regularly, but I've actually just stopped. I figure like it'll do what it does, and if it becomes a useful currency, I'll just use it for something. Buy a book or something. Or a couple of books, maybe.
Just don't throw out your computer with its credentials on it. I know that doesn't really exist in this case.
No, it doesn't. I don't have a wallet or anything like that.
But did you hear about that guy that however many years ago he had a huge amount of Bitcoin on it, but Bitcoin back then was worth like nothing, so he didn't really think about it. Or so he claims anyway, and he just took out the hard drive, did stuff to it, and he reckons he lost millions of bucks if he still had it now.
Well, that's the way it goes, isn't it?
Yeah.
I mean, like, you never would have picked that Bitcoin would do what it did.
No.
So it's not really like you've made a stupid decision. It's just something that happened.
Yeah. What did you buy Ripple for?
$1.50.
Oh, okay. Yeah, it's only like $1 at the moment.
Oh, that's all right. Yeah, it got up to $1.40 something.
So close.
Yeah, I know. I actually don't really I'm kind of
You passed the cryptocurrency phase.
I've passed the cryptocurrency phase. I mean, so I've been listening to a lot of books. So I mentioned that I was listening to The Intelligent Investor by Benjamin Graham.
Yeah.
And I have also listened to Stocks for the Long Run by Jeremy Siegel.
Okay.
And Common Stocks and Uncommon Returns by Philip A. Fisher. And something I've noticed that I found a bit funny is, although they all have different narrators on Audible, which is where I listen to them, they all sound exactly the same. I don't know if it's just the same the same content in the book, or if it's just that particular subject attracts a very similar type of person to read it.
Could be.
Like it's not unpleasant, but they kind of have, it's all men.
Yeah.
For one thing.
Of course. Yeah.
And they all have kind of, slightly, I don't know how to describe their voices, but, deep, relaxed, but also very strong and confident, if you know what I mean.
White collar workers.
White collar workers, exactly, yeah.
Mm.
Which I am, obviously. But, just an observation. Nothing good or bad about that, I suppose.
Except it starts to all blend together and you couldn't tell me which bit was from which book, probably.
That is absolutely true, yes. I feel like I should probably be buying paper copies of these, though, because there are certain parts that I kind of feel like I should highlight and refer back to at some point.
Okay, so there's a few nuggets in there, you think?
Oh, there are tons. And I mean, but some of it's more just general advice.
What's the most reoccurring theme that they talk about?
Look, the most reoccurring theme is two of them are actually just more. So Stocks for the Long Run and The Intelligent Investor, they're actually just more kind of general advice books. So they kind of speak to you as as an investor. And they kind of just give general advice. They don't specifically, although one was written by Benjamin Graham, I think another person wrote it with him as well. They don't really talk necessarily from their own viewpoint, what works in their experience. They talk more analytically. But the last one I listened to, Common Stocks and Uncommon Returns, that was written by someone who I think managed a hedge fund. So I mean, they're all written by pretty big money managers, but he spoke more from his own personal experience, and he spoke about how he does his own research. And I think that like his had a lot of kind of specific things that you should be doing, whereas the other two just had more general advice about how you should look at and approach the share market. The things that they kind of spoke about and the common things seem to be don't kind of try and buy at a certain time and sell at a certain time. Just trust that if you've picked a good company, the market will find the value of that good company. And make sure you research your companies well and make sure you pick companies you understand, which I think is something I mentioned last week. But, like if you are a customer of a company or if you work in a certain field, you'll have a better understanding of that than, something that's totally alien to you, like I guess
farms.
Farms, yeah, or I was going to say pharmacies, but same thing, I suppose. Yeah, so I suppose those were kind of the two more common things. And I think most of them went into some degree of technical analysis, which is where they actually talk about how you should research a company. But both of them basically say that, the books can only tell you so much, and in the end, it's going to come down to a certain factor of you understanding the company enough to know that even if the books don't tell you, it's probably going to be profitable in the long run because of what you know.
No, it's fairly sound, but kind of generic advice.
Well, it is, isn't it? Yeah. But yeah, and also pick good company stocks on major stock exchanges. Don't try and search for that little company that's going to explode and make 10,000% return, because those are 1 in a million, and there's no way really to know if it's going to happen or not.
Absolutely. Thanks again for joining me, Alex.
Not a problem, David. Pleasure as always.
You can follow and get in touch with us on Twitter at Tangential Soup, and you can find this week's show notes for more information about today's topics at tsp.fm/33. If you enjoyed today's episode, please consider sharing it with anyone you think might also. And we'll talk to you again next week. Bye.
Ciao.